Hey Bowtie Nation, Joseph Hogue here with the Let's Talk Money channel and another one of these informal update videos. I love doing these because I get to share what I'm watching in the market, the biggest news in stocks, and just kind of have a conversation with you. And Nation, one of the biggest themes in the financial news right now is how supposedly retail investors, so Main Street investors like you and me, are skewing the market. Right, supposedly we're out there buying up shares of Tesla and American Airlines and irrationally driving up prices for those stocks. Because Wall Street never thinks Main Street investors know what they're doing. There are even investing terms for this kind of thing among the analyst community, okay? The smart money is the investment flows from institutional investors, so those billion-dollar hedge funds, while dumb money is the order flow on the retail side, the nameless millions of Main Street investors are buying. And among the analysts, the saying has always been follow the smart money. Buy what those institutional investors with their army of analysts are buying and short the dumb money stocks. But I wanted to put this to the test because also lately we're seeing regular investors like you out there in the Bowtie Nation just obliterate those hedge fund managers and stock returns. Research by Goldman Sachs shows the retail investor portfolios on Robinhood are up 61% since that rebound started in March, versus only a 45% return for those hedge funds over the period. So I went looking for investor quizzes and found one by FINRA. Now that's the Financial Industry Regulatory Authority. They oversee brokers and investment platforms. And what I found just blew my mind. In the beginner investing quiz we'll look at, a 15-question quiz, kind of like a stock market for beginners, more than 2 out of 3 investors failed it. 2/3, about 65% of the investors couldn't answer more than 9 of these questions correctly. So what I want to do with this is take you through that investor quiz. We'll look at all 15 questions. I'll give you time to see each and respond. Then we'll look at the answers, see how you did, and talk through them. Nation, this kind of beginner investing knowledge is so important. I know it's not as sexy as picking stocks to buy, but this kind of knowledge is going to determine whether you make money investing or just lose it all to those big money players. Before we get to it, I want to send that shout out to all you in the nation. Thank you for spending a part of your day to be here. If you're not part of the community yet, just click that little red subscribe button. It's free and you'll never miss an episode. So let's look at the quiz. I'll read through each question separately, give you time to answer, and then we'll look at the answers. The questions are more basic to start, but do get more difficult, so make sure you watch the entire quiz and see how you did. So first question here. If you buy a company's stock, then A, do you own a part of the company? B, you've lent money to the company. C, you're liable for the company's debts. Or D, a company is going to return that original investment to you with interest. Or, the last one here, not sure, don't know. Okay, so if you buy a company's stock, what does that mean? Do you own a part of the company? Have you lent money to the company? Are you liable for the company's debts? Or is the company going to return that original investment to you with interest? And I'm going to go ahead and check our answers, check the correct answer in each one as we work through it. If you take the test online, you actually go through all 15 and then you get your results and get to see each one. But I want to address each individual question and its answer together just so we can kind of keep them straight and use it kind of as a learning tool. And I got 100% here. Don't feel bad if, as we work through these, you miss a few. Like I said, the vast majority of investors, only 35% of people even get 9 or more questions correct. Okay, 65% of investors are going to fail this test because there are some pretty difficult questions here in the test. But it's a great learning experience, a great way to understand some of these beginning investment concepts and ideas. And so don't feel bad if you miss a few. Answer 1, though, if you buy a company's stock, you own a part of the company. Okay, that's stocks, equities. You've got equity in the company. Okay, you own a piece of that company theoretically, right? Stocks are known as equities because each stock share represents a small percentage of ownership in the company. Usually they entitle you to a vote in the election of directors and other things on that proxy. So every year at the annual meeting, you might get a proxy statement in the mail where you can make a little vote for your shares. You're also going to get a share of those dividends and any cash flow that the company pays out. So you own the company. And that's the great thing about investing in the stock market is, we can't all own our own business. We don't all have enough time to create companies, create those assets, but you can invest and own a piece of a company, without having to spend the time to do it. Okay, number two here. If you buy a company's bonds, so that last question was if you buy a company's stock. Now, if you buy a company's bonds, A, you own a part of the company. B, you've lent money to the company. C, you're liable to the company's debts. Or D, here you can vote for shareholder resolutions. Okay, so you can vote for some of those proxy statements. Or again, here E, you don't know or not sure. So again, if you buy a company's bonds, you own a part of the company, you've lent the company money, you're liable for the company's debts, or you can vote on the shareholder results. And the answer here, if you buy a company's bonds, you have lent the company money. Okay, that's what a bond is. A bond is an indenture. It's a loan to the company that it pays back with interest, and then has a maturity where it pays back the proceeds of that loan. Okay, so here it says bonds are loans that investors make to a corporation or government body in exchange for regular interest payments and return of principal at a future date. Okay, so again, the companies are going to issue those bonds. You're going to buy the bonds. That money goes to the company, and it can use it for growth, or sometimes to buy back its shares, sometimes to send dividends back for the shareholders. And then twice a year, most company bonds, twice a year, they pay out interest rate. And it's a set interest payment, or a set interest payment that it's going to pay out for however many bonds you own. And so it's going to do that twice a year, send those interest payments out. And then at the future date, when that bond matures, that's the maturity date. It might be 5 years, 10 years, 30 years. There's even been 99-year bonds. But when that bond matures, it's going to pay back the face value of that bond. So most bonds are issued at $1,000 face value. So if you buy one bond for $1,000, at the end of that 30 years, it's going to send that $1,000 back to you, in addition to all the interest payments that you've received. And bonds are hugely misunderstood by investors, especially Main Street investors. These are some great assets to have in your portfolio. Some must-have assets in your portfolio. In fact, I've got a video on fixed income investing, so bond investing, how to find bonds, how to pick the best bonds for your portfolio, and how to pick bond funds to put in your portfolio. So look for that video. I'm going to link it in the video description below. It's going to be how to pick bonds and invest in bonds. Question number 3 here, another one on bonds. Which type of bond is the safest? So A here, you've got the U.S. Treasury bond, so the bond issued by the U.S. government. B is a municipal bond, and those are municipal bonds are those issued by local municipalities. So state and local governments can issue bonds as well, just like the federal government. C here is corporate bonds, so bonds issued by corporations. Or D here, don't know, not sure. Okay, so which types of bonds are the safest here? Out of these 3 selections, which are safest? U.S. federal treasury bonds, municipal bonds, or corporate bonds? And the answer is a U.S. Treasury bond is typically the safest. Okay, in fact, the U.S. 10-year Treasury is known as the risk-free asset. Okay, it is as riskless and as risk-free as you get with investments, even among other federal government or other foreign government bonds. Treasuries are issued by the federal government. Unlike corporate or municipal bonds, they're backed by the full faith and credit of the U.S. government, which guarantees the interest payments and has always been able to make those payments and redeem them at maturity. Okay, that's not saying that someday maybe the U.S. government won't default on its bonds, but it is extremely very unlikely. In fact, the simple fact that the government can always just print more cash, print more money, then it's not going to default on these bonds. Question 4 here. In general, okay, so now this is in general, if interest rates go down, then bond prices do what? Okay, there is a very close connection between interest rates and bonds that I'll explain in the answer. But in general, if interest rates go down, then bond prices do what? A, bond prices go down. So if interest rates go up or go down, bond prices A, go down, B, go up, C, are not affected, or D, don't know, not sure. Okay, so if interest rates go down, what do bond prices do? Go down, go up, or are not affected? And the answer is, if interest rates go down, then bond prices generally go up. Okay, this is they say here, the cardinal rule of bonds, and it is the ultimate first rule of bonds. When interest rates falls, bond prices go up. And conversely, when interest rates rise, bond prices fall. Okay, this is because as interest rates go up, newer bonds come to market paying those higher interest rates that are available in the market, right? And the older bonds that are already in the hands of investors, that with those interest rates on the older lower rates, they're not quite as they're not as attractive, right? Because understand that most bonds, they have those fixed interest rates, right? You buy a bond with a 4.5% interest rate. Okay, so it's going to pay you 4.5% on the face value of that bond. It's going to pay you that on an annual amount set up twice a year. So 2.25% twice a year on that bond. That might be a great deal when that bond comes out, that 4.5% return, that 4.5% yield. What happens though if interest rates go up? So interest rates go up, Fed raises interest rates, and now people are out in the market. They're buying bonds with yields of 5 and 6 and 7%. Well, if you're trying to sell that bond with 4.5% yield, someone's looking at that bond and saying, no, I can get a 7% yield easily in the market right now. Why am I going to buy your bond for 4.5%? So what you have to do, you have to lower the price that you're willing to sell that bond for. When you lower the price, then the yield that they're going to collect is going to be higher, right? It's going to match the market, the 7% market yield that's available in the market. So interest rates go up, bond prices go down. Okay, and conversely, as it says here, if interest rates go down, that bond that you invested in that pays 4.5% over the next 30 years, if you're looking at like the U.S. Treasury right now pays like 1.5%. If you got a 4.5% yield bond to sell, people are salivating over that, man. You can raise the price of that, and people are going to pay it just to get that 4.5% yield. Question 5, which of the following is the best definition for a junk bond? Okay, another type of bond here, kind of a category of bond that we'll explain in the answer here. So what is a junk bond? A is a bond that is rated below investment grade by rating agencies. B is a bond that has declined dramatically in value. C, a bond that is defaulted. Or D here, a bond that is not regulated, or not sure. So again, what's a junk bond? A, something that's below investment grade, rated below investment grade by the rating agencies. You've got Moody's, you've got S&P. B, a bond that has declined dramatically in value. C, a bond that is defaulted. Or D, a bond that is not regulated. And the answer is, best definition of a junk bond is a bond that is rated as below investment grade by the rating agencies. Love this one because a lot of times these junk bonds, they're not necessarily junk. Even bonds that are rated below investment grade, which is actually about a triple B. So you've got the investment rating agencies, you've got the S&P, you've got Moody's. Anytime a company wants to issue a bond, they go to these, they pay them to assign a rating, kind of a risk rating to these bonds. S&P will look at the company's finances, look to see what the debt is backed by, if it's backed by the company or just maybe a project or whatever, and they'll say, okay, you know what, on a scale of from AAA all the way down to triple C, and everything in between, so AAA, AA, triple B, double B, B, all the way down to triple C, which is bonds that are in default, bonds that aren't paying back. We're going to say this bond is, triple B, right? And that's actually the last level of investment grade. Anything below triple B is below investment grade, as they call it, or junk bonds. And it's very important because a lot of times, so larger institutional money managers or pensions or banks, they can't invest in bonds below investment grade, right? So it's very important for a company to issue a bond above that investment grade, an investment grade rating, and they can pay lower rates, So bonds below investment grade are called junk, or they're called high yield, right? Nobody likes to be called a junk bond, but they're called junk or high yield bonds issued by companies with poor credit ratings, or sometimes a bond that just isn't very good. Compared to better investment grade ratings, the risk is greater that these companies are going to default on those interest payments or even go bankrupt and unable to redeem the bond as it matures. Okay, so investment grade debt, below investment grade debt, or junk. So number 6, a no-load mutual fund is one that, no load. What does no load mean for mutual funds? It means A, carries no fees. B, carries no sales charges. C, does not contain high-risk securities. or D, has no limits on the period of time in which it can be bought or sold. Okay, so what's a no-load mutual fund? A, carries no fees. B, carries no sales charges. C, does not contain high-risk securities. Or D, has no limits to the period of time which it can be bought or sold. And this is going to be very important for those of you still buying mutual funds, maybe through your 401k. Very important question to know what a no-load mutual fund, what that no-load means. The answer, a no-load mutual fund, is one that carries no sales charges. Okay, so now this one might be a little confusing. I know a lot of people are going to miss this one. Don't feel bad if you missed it, because I know a lot of people are going to pick that A, carries no fees. But a no-load mutual fund, okay, a load on a mutual fund is a sales charge. And it's either going to be a sales charge when you buy it or when you sell it, okay? And these are very important. There is no reason you should ever pay a sales charge, ever pay a load fee for a mutual fund. Okay, if you want to buy a mutual fund, maybe if it's in, you don't have a choice, only have mutual fund options in your 401k a lot of times, then yeah, you're gonna have to go with a mutual fund. Never pay a load though. There's no reason for it. There are other options available, and what these loads are, they might be 1 to 5% of your money when you buy that mutual fund or when you sell it. Okay, so if you've got a loaded mutual fund where you have to pay a 5% sales charge to buy it, you invest $100, you're out $5 already. You're out 5% of of that investment that you have to make up through the higher price just to get even. No reason for it. There are always ETFs, exchange traded funds, you can buy with no sales charges. There's also usually mutual funds with no sales charges as well. So this says not all mutual funds charge a sales load. Called no load funds, these funds do not charge a front end sales charge or deferred sales charge. So buying or selling. So front end or deferred sales. Deferred sales is going to be when you sell it. Again, you'll want to look for things that 12B1 fees sometimes is what these called. Whenever you're buying a mutual fund or an ETF, you always want to look at that expense ratio as well. It makes no sense. A lot of people will come to me and will say, well, I got the fund with no load, so no sales, no front end load fee on it, but the expense ratio is like 2.5%. So every year they're paying 2.5% of that investment in the expense ratio. No sense at all. Again, there is no reason why you should pay a load fee on a mutual fund or anything over 1.5% even. There's no reason for it. Go with a low cost, low expense ratio mutual fund or an ETF. So I actually have kind of a love-hate relationship with mutual funds. In the 60s, 50s, 60s, 70s, they were great. They brought a lot of people into investing, people that, really didn't have the time or the experience or the knowledge to pick stocks. So mutual funds were a great way to, give them a portfolio of diversified stocks, put them together, and let them invest in the stock market. Got the American public investing in the stock market. But they're kind of outdated and they just cost way too much. There's so many reasons why I prefer ETFs, that's exchange traded funds. They trade just like stocks, but they do the same thing as mutual funds, and they're so much cheaper. So what I'm going to do, I'm going to link to another video in the video description, dividends versus ETFs. So another very popular topic here on the channel is dividend stocks, dividend stock investing. And a lot of people have asked me, okay, should I invest in individual dividend stocks or ETFs? So look for that link in the video description below, dividends versus ETFs. It's going to tell you all about ETFs, why you should invest in those, why you should put those in your portfolio instead of maybe other mutual funds. Number 7 here, moving right along. In general, investments that are riskier tend to provide higher returns over time than investments with less risk. Okay, so this is the relationship between risk and reward in investments, and there is a very significant and time-tested relationship between these two, between risk and reward. So the question is, investments that are riskier, so riskier investments, tend to provide higher returns over time than investments with less risk. And this is true or false. So A is true, B is false. And the answer, in general, investments that are riskier tend to provide higher returns over time compared to investments with less risk. And that is true, okay? Just in general. Now, of course, this isn't always the case. With interest rates coming down as fast as they are, a lot of bonds and bond funds have been excellent returns this year. And those are, as we've seen, less risk. But in general, for investors to take on more risk in investment, they're going to want a higher return. And how that works out in the market is, investors are just going to adjust prices of they're willing to pay for an investment according to that risk. Okay, so if I'm buying a stock that can go up or down 20% in a day or in a matter of weeks, I'm going to be a little bit hesitant to pay a whole lot for that stock because there's a lot of risk in that compared to maybe a lower risk bond or a lower risk stock. So in general, stock that is riskier is going to tend to perform to pay higher returns. Question 8. Which of the following organizations insures you against losses in the stock market? Okay, so which of these organizations here is going to pay you back, insure you against losses in the stock market? We've got A, the FDIC, that's the Federal Deposit Insurance Corporation. B, FINRA, the Financial Industry Regulatory Authority. C, the SEC, that's the Securities and Exchange Commission. D, the SIPC, Securities Investor Protection Corporation. Or E, none of the above. Or then, after that, don't know, not sure. So which of these organizations, these government organizations, is going to insure you against losses in the stock market? You got the FDIC, FINRA, the SEC, the SIPC, or none of the above. And the answer is none of the above. And this is another one that's a little bit confusing here. So which of the following organizations insures you against losses in the stock market? Now, the FDIC, that's actually the bank one that insures losses on a bank if a bank goes bankrupt or something like that. FINRA, the Financial Industry Regulatory Authority, that's the, they're going to regulate a lot of the platforms and the brokers. The SEC, the Securities Exchange Commission, they set a lot of the rules for the for the markets. And the SIPC, they're the Securities Investor Protection Corporation. Now, this isn't insurance, though. This isn't going to insure you against losses in the stock market. You can still lose money, and we'll get to what they actually do here. Now, when you invest in stocks, you accept that risk in your investment that might decline as well as rise in value. Okay, so here it says primary role of the securities regulators, such as FINRA and SEC, is to ensure that securities laws and regulations are followed and punish violators. Okay, so FINRA and SEC are securities regulators. They're going to regulate the brokers and the platforms. The FDIC generally insures checking, savings, and other deposit accounts, so banks, when an FDIC-regulated bank fails. The mission of the Securities Investor Protection Corporation, the SIPC, now this one is to return funds and securities to investors if the brokerage firm holding these assets becomes insolvent. Okay, so this is very important. Anytime you invest on a platform, on a stock investing platform, or you invest with a broker, make very clear that you see that they are covered under the SIPC, okay, the Securities Investor Protection Corporation. Because while this is right, it's not going to protect you from losses in stocks. Okay, if your investments fall in value, you're still going to lose money. But if the brokerage firm or that investing platform that is holding those securities for you that you're investing through, if they become insolvent, or maybe if they do something that breaks the rules and they go bankrupt, then the SIPC is insuring those losses. Okay, they're going to return those funds and the securities to you if that happens, but not in the case of your investments just lose value. All right, question 9. We are over halfway through this, and remember, less than 35% of the people that take this test get more than 9 correct. Okay, 2/3 people, investors, are going to fail this, so don't be too worried if you're getting a little bit behind or you've missed a few. Question 9. If a company files for bankruptcy, which of the following securities is most at risk at becoming virtually worthless? Okay, so which of these investments, which of these securities is basically worthless after a company files for bankruptcy? That's A, company's preferred stock, B, a company's common stock, C, a company's bonds, or D, don't know, not sure. Okay, so which of these investments is worthless after bankruptcy? Preferred stock, common stock, bonds, or not sure? And the answer, the company's common stock. Okay, so if a company files bankruptcy, the common stock, the equities sold, the ones you buy on that stock investing platform, are going to be worthless. Okay, and here we're talking about liquidation. So if a company liquidates, ceases to be a company, then it's going to sell its assets, right? It's going to sell everything it owns, and it's going to pay off all its debts in an order. Okay, first get paid back the bondholders. Okay, so those are the loans that people loaned the company money, and they're going to try to pay all those bonds back. And if they pay off all that debt, if they pay off all the bondholders, then next in line here is the preferred stockholders. Okay, it's kind of a hybrid between bonds and stocks. Preferred stockholders are higher up on the food chain, as it were. Okay, and then last and pretty much last and least here is common stockholders. Okay, and that's just the risk you take when you invest in a stock. Okay, so here it says, among the claims to a bankrupt company's assets, shareholders of common stock have the last claim on assets, falling in line behind secured creditors, bondholders, owners of preferred shares. Common shareholders may not receive anything if the secured and unsecured creditors' claims are not fully repaid. Question 10. Okay, which of the following best explains why many municipal bonds pay lower yields than other government bonds? Okay, so like we talked about, municipal bonds are bonds issued by state and local governments. Okay, they're fairly safe, but not quite as safe as the federal government bonds, the treasury bonds. And they do tend to pay lower yields, okay, which is kind of odd because you'd think, like we talked about before, more risk equals more return on general. Okay, people, if they're taking more risk, they're going to want a higher return. But these municipal bonds, they're riskier than the federal government, obviously. You don't know if that state or local government is going to be able to repay those bonds, but they usually pay a lower yield. So what's the deal here? Why do many municipal bonds pay lower yields than government bonds? A is municipal bonds are lower risk. And I just kind of gave that one away because I said, municipal bonds are a little bit higher risk in general. But A, municipal bonds are lower risk. B, there's a greater demand for municipal bonds. So maybe there's so many investors that want these types of bonds that they push the yield down, okay, for just that supply and demand. Or C, municipal bonds can be tax-free. Okay, so why are municipal bonds paying lower yields than federal government bonds? They're lower risk, there's more demand for municipal bonds, or they are tax-free. And the answer here is because municipal bonds can be tax-free, okay? Federal tax, sometimes even state taxes. So which is the best explains why municipal bonds pay lower yields than government bonds. Okay, and here it says because dividend payments from municipal bonds, those interest payments actually, are usually exempt from federal income tax. Even with lower yields than government bonds, their after-tax rates of returns are attractive to investors in those higher tax brackets. So very important concept here. Once you get into a little bit higher tax bracket, and this is usually right around 20% or higher. Okay, so if your income is high enough, you're paying 20% or higher on those marginal tax brackets when you file your income taxes, you need to start looking at municipal bonds, okay, because that tax-free interest is actually making those yields a little bit more attractive, right? So it's lower yields. The people that aren't paying quite as much taxes, they just want to go with the government bonds because it's higher yield and they're not really paying that much in taxes anyway. The municipal bonds, if you're a higher tax rate, then you can get that money tax-free, which if you're paying 30% of your money, getting $100 in interest, if you're paying 30% on your money, that's $30 that you got to pay out of that 100% interest, if it's taxed as income. Whereas if it's tax-free municipal bonds, you get to keep that $100. So it's very powerful. If you're in the higher tax brackets, start looking at municipal bonds. Question 11. Okay, this is going to be a fun one. Okay, you invest $500 to buy $1,000 worth of stock on margin. Okay, so if you don't know what margin is basically most investing platforms, you can borrow money. If you've got, say at least $100 or $200 in the account, you can borrow money on that to invest more than you actually have. So here you've got $500 in the account. You're investing $1,000 worth of stock on margin. So $500 of that money is borrowed on margin. Now the value of your stock drops 50%. I'm sorry, it falls 50%. You sell it. Approximately how much of your original $500 investment are you left with in the end? Now, this is going to be a very important question for understanding margin and understanding what happens when you borrow money to invest, when maybe things don't go your way. So excellent question here. I love this. You invest $500, buy $1,000 worth of stock with that borrowed money. What happens if the stock price goes down 50% and you sell it? How much of your original $500 investment are you left with? And of course, A here is $500, B is $250, or C is 0. Okay, so how much of your original $500 do you have left? 500, 250, or 0? And the answer is 0. You lost all your money in this. And let me explain why. I'll read what they've got here. When you buy a stock on margin, you risk losing the entire investment. Okay, or even more sometimes if you're in futures and you're very much leveraged. In this example, the investor used $500 to buy $1,000 worth of stock. So they borrowed that additional $500 from the brokerage firm to make the purchase. When the stock was sold after dropping 50% of the value, its remaining worth was only $500. And that's the same amount that the investor still owed to the brokerage firm for that margin loan, for the money that they borrowed, all right? So they borrowed $500 on top of the $500 that they already had to invest $1,000 in the stock. Now, the stock lost $500. That $1,000 worth of stock dropped 50%, $500 is left. Well, they still have to pay off the brokerage firm. They still have to pay off that $500 loan. So they're essentially lost all their money. And that's a very important lesson for margin investing. I know since March, the market is up 40%, and it's great to think that, hey, if I've got $100, I borrow another $100 to invest in the market, and I can basically double my return by borrowing money and getting that return. But it goes the other way as well. And you never know when the market's going to turn. You never know when the market's going to turn against you. So be very careful of that. Now, these are some great questions, and not only to test your investor knowledge, but really is some of the most important questions that you need to be asking yourself. These questions about margin, these questions about stocks versus bonds, and what happens to bonds when interest rates go up. Excellent questions and answers that every investor must know. I've also got another video though I want you to click through. This is probably one of the most important videos that I'll link in the video description below. The most common questions, the 9 most common questions that I get from investors, answers to these every investor must know. So basic stock market investing questions that you really need to be able to know the answer to and before you start investing. So 9 common questions of common investor questions. Look for that link in the video description below. Number 12 here, a few more left. We have 15 questions here. Number 12, which is the best definition of selling short? Okay, definition of selling short. What are you doing when you're selling a stock short? A is selling shares of a stock shortly after buying it. So you buy a stock and then you sell it very quickly afterwards. B, selling shares of a stock before it has reached its peak. Okay, so selling short, selling shares of a stock before it's reached its peak in price. C, selling shares of a stock at a loss. So if you're selling shares of a stock that you bought at a higher price, it's now at a lower price, you sell it at a loss, is that selling short? Or D, selling borrowed shares of stock. Okay, selling borrowed shares of stock. So what is the best definition of selling short? Selling shares of stock shortly after buying it, selling shares of a stock before it's reached its peak, selling shares of a stock at a loss, or selling borrowed shares of a stock. The definition of selling short here, selling borrowed shares of a stock. Okay, so here it says, short selling involves borrowing stock from a broker through a margin account and selling it, with the understanding that it must later be bought back and returned to the broker. So if the stock declines in value, the short seller hopes, and this is what they're hoping, is that the investor is going to profit when the value of stock borrowed and sold would be higher than the stock it's kind of confusing the way they say it. Okay, basically you're selling short, you're betting that the stock price is going to go down, right? So instead of buying the shares, right, when you think a company's stock price is going to go up, you buy the shares. When you're selling short, and the idea there is that you buy the shares at one price, stock goes up, you sell the shares at that new higher price. It's just the opposite when you're selling short, right? You're betting the stock price is going to go down, so you borrow the shares of stock from someone else on your platform, and then you're hoping, because you have to return those shares of stock. Say the stock is trading for $100, right? You borrow those shares of stock. You're hoping that it's going to go down to $70, and you sell it at that price, right? You borrow the shares, sell them for $100, and you've collected $100 times five, right? Five shares of stock, you've collected $500. Now your hope is that those shares are going to go down to $70, right? And then you can go back into the market, buy them at that $70, and then give them back to the person that you borrowed them from, right? So you borrowed them from one investor. You sold the shares when you borrowed them for the $100 each, $500 you collected. Now, if they go down to $70, you buy them in the market. You pay $350 to buy those shares, and so you can return those 5 shares to the stock investor that loaned them to you. And look at that, $350, $500. You pocketed that $150. The problem is it can go the other way. Just like buying a share of a stock, the price can go down. If you're selling short, the price can go up too. A lot of people, this is what Elon Musk is talking about in shares of Tesla, right? Crushing the short sellers, the people that have bet against the stock, that are borrowing the stock to sell it short and are hoping the price goes down so they can go into the market, buy up those cheaper stocks and give it back to the borrowed people. So just understand what is happening when you're selling that stock short. And besides the selling short, besides the difference in the price, you're also going to have to pay a margin interest rate to the broker platform, right? So you're not just getting a free ride here. You're going to have to pay to sell stock short. Number 13, hedge funds are always subject to the same rules and regulations as mutual funds. Okay, so hedge funds are, these institutional funds set up by money managers, set up by large companies to, invest. They put a group of investments together like a mutual fund, like an exchange traded fund, and then sell shares in that hedge fund or collect money investments from individual investors. Mutual funds, of course, just like that, groups of stocks, group of investments put together and managed by an investment manager. Okay, so it's going to be a true or false question here. Hedge funds are always subject to the same rules and regulations as mutual funds. A is true, B is false. And the answer, hedge funds are always subject to the same rules and regulations as mutual funds. This is false. They are completely different, different organizations, different entities, and regulated differently by the SEC. Okay, so here it says hedge funds are basically private investment pools because they're usually only open to a limited number of wealthy, financially sophisticated investors. And I hate that, and we'll talk about that. And do not advertise publicly or offer their securities. Private hedge funds are usually not required to register with the SEC. As a result, unregistered private hedge funds do not provide the investor protections that apply to these other registered investment products such as mutual funds, stocks, bonds, mutual funds, things like that, right? So what they're saying here is there are certain investments, hedge funds, venture capital, alternative investments that are only open to what they call accredited investors. And these are people with $1 million or more net worth or a certain level of income. And the SEC says, hey, if you got that much money, you must know what you're doing, right? So you can invest in these hedge funds and, we're not going to regulate the hedge funds or these alternative investments or venture capital so much because supposedly the investors know what they're doing. We don't have to protect them, right? So just know that if you are investing in these hedge funds, venture capital, startup companies, things like that, there aren't going to be quite as many protections or a lot of times quite as much reporting for these. Question 14, just 2 questions left here. The principal difference between mutual fund share classes, so class A, class B, class C, etc., is A, the different investments each class makes. B, the different fees and expenses each class charges. Or C here, the different investment professionals in charge of managing each class. Okay, so if you ever invested in a mutual fund, a lot of times you'll see, like the American Class Mutual Fund or American Shares Mutual Fund, and then they'll have Class A, Class B, or Class C shares to choose from. So what's the difference between those different classes of shares? A, different investments that each class makes. So each class makes different investments, different stocks maybe. B, the different fees and expenses that each class charges. Or C, the different investment professionals in charge of managing each class. Okay, so, maybe there's somebody different running each class of those shares. And the answer, the principal difference between mutual fund share classes, so class A, class B, class C, is just the different fees and expenses that each class charges. Okay, and I'm not going to try to read through the explanation they have here because it is very confusing and we'll just get lost in it. But just know that so with the different share classes, when you buy a mutual fund, they can make the same investments in each. You might have the same fund manager managing each, but they're just charging different fees and expenses in each share class. Okay, so a lot of times that's the only reason. That's the only difference. And question 15, last one here. A Section 529 plan is a tax-advantaged way to save for, okay, A is college, B, retirement, C, long-term health care, or D, don't know, not sure. So what is a 529 plan used for to save? College, retirement, or long-term health care? And the answer, a 529 plan is tax-advantaged way to save for college. These other ones, so you've got 529 plan is a way to save for college. IRAs, Roth IRAs, 401k plans are ways to save for retirement, tax-advantaged ways. And an HSA, a health savings account, is a way to save for long-term health care. And highly recommend using all of those, okay? These are extremely important. Different savings vehicles, different investing vehicles, tax advantage on each of these. You're going to get, you're going to be able to take money off of your current income taxes, or you're going to be able to not, you're going to pay for things that you need without paying taxes on the money you bring out from your investments. Okay, so very important. 529 plans are a way to pay for college. Basically, you pay in with that. And for the most part, it's going to be, after-tax money, but you get to take that money out, you invest it, it grows while it's in that account, and the money that you take out and pay for those college expenses comes out tax-free, right? So while you're paying your, you're paying your income taxes on the money that you put in there, it's after-tax money, so you're already paying those income taxes. But you'll never pay taxes on those returns. The returns, the investment returns you make in that account, you never have to pay taxes on them, and that's powerful. Okay, that is a very powerful way to invest, a very powerful way to pay for something that you're going to have to pay for anyway, most likely. Retirement, another thing, and these long-term healthcare plans, these HSAs, learn what these are, folks, and use them. Use them to the max because these are very powerful savings and investment vehicles. So how'd you do? Were you able to get 9 or 10 out of the 15 right, or maybe even more? Don't feel bad, again, if you didn't get at least 9 right. Like I said, only 35% of the investors that take this quiz will get more than 9 right. Either way, make sure you check out the links in the video description below to those videos and the most important investing questions. Click on the video to the right for those 9 investing questions every investor must be able to answer. It's a great video for giving you those basics and beyond for investing. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.